If you have a bank account and you are over 60, pay close attention to the next few minutes. The IRS has started sending out a new round of warning letters in 2026, and millions of Americans have already received one without fully understanding what it means or what they are supposed to do about it. Some people are throwing these letters in the trash thinking it is junk mail. That is a mistake that could cost you real money. By the end of this video, you will know exactly which 5 types of accounts triggered these letters, what the letter actually means in plain English, and the specific steps you need to take to protect yourself. No confusing legal language, no government double talk, just the facts you need, explained the way a good neighbor would explain them. Let us get into it right now. The first thing you need to understand is that these letters are not random. The IRS does not send warning letters to people by accident. They use a system that flags accounts based on specific patterns. Think of it like a smoke detector. The detector does not know if it is a real fire or burnt toast. It just knows something triggered it. Your job is to figure out which one it is before the situation gets worse. So what are the 5 types of accounts that are getting flagged right now in 2026? The first account type is a high balance savings account that has had little to no reported income connected to it. Here is what that means in everyday language. If you have, say, $40,000 or $50,000 sitting in a savings account, but your tax return shows very low income, the IRS computer system sees a mismatch. Where did that money come from? Now, there are perfectly legal explanations. Maybe you sold a house. Maybe you inherited money from a parent. Maybe you saved it over 40 years of work. The IRS does not automatically know the story. They just see the numbers do not line up on paper, and they send a letter asking you to explain it. This is not an accusation. It is a question. But if you ignore it, it becomes a much bigger problem. The second account type is any account connected to a side income that was not reported on a 1099 form. This is a big one for seniors in 2026 because a lot of people are picking up extra work. Maybe you are selling things on an online marketplace. Maybe you do some babysitting or lawn care for neighbors. Maybe you rent out a room in your home. If any of those payments were made through apps or digital payment platforms, and if those payments added up to more than $600 in a year, the platform is now required by law to report that to the IRS. If you did not report it on your taxes first, the IRS now has information that you do not know they have. That triggers a letter. This is why you need to subscribe right now and turn on notifications. These rules changed, and most people found out too late. Hit that subscribe button so you hear about these updates before they land in your mailbox. The third account type is a joint account where one person on the account passed away. This is one that catches a lot of widows and widowers completely off guard. When a spouse passes away, any bank account or investment account that still carries both names can trigger an IRS review. The system is looking to make sure that the estate was handled properly, that any inheritance taxes were addressed, and that income from that account is being reported under the correct Social Security number going forward. If you lost a spouse in the last 2 or 3 years and you still have joint accounts that have not been updated, you may receive one of these letters. It does not mean you did anything wrong, but you do need to respond. The fourth account type is a retirement account, specifically an IRA or a 401k, where the required minimum distribution, which is the amount you are legally required to take out each year once you reach a certain age, was either not taken or was taken in the wrong amount. Here is the simple version. Once you turn 73 years old, the government requires you to take a minimum amount of money out of your retirement account every year. They set that number based on your account balance and a formula tied to your life expectancy. If you did not take out enough, or if you took out too much and tried to put it back in correctly, the IRS notices. The penalty for missing your required minimum distribution used to be 50% of the amount you should have taken. In recent years, that was reduced, but it is still a significant penalty. If you received a letter and you are over 73, this is the first place to look. The fifth account type is a health savings account, commonly called an HSA, that was used to pay for expenses that do not qualify under IRS rules. Health savings accounts are one of the best tools available to people on certain health plans. The money goes in tax-free, grows tax-free, and comes out tax-free as long as it is used for qualified medical expenses. But the list of what qualifies is very specific. If your HSA was used for something that does not meet the definition, the IRS can flag that account and require you to pay taxes and penalties on those withdrawals. Now that you know the 5 account types, let us talk about what the letter actually looks like and what it means. IRS letters have a notice number in the upper right corner. The most common ones you might see right now are CP2000, CP14, LT11, and letter 6419. Each one means something slightly different. A CP2000 is one of the most common. It means the IRS found income on their records that does not match what you reported on your tax return. It is not a bill. It is not a final decision. It is a proposal. They are saying, here's what we think you owe based on what we know, and they are giving you a chance to agree, disagree, or provide more information. A CP-14 is a bill. That one means the IRS believes you owe money and you have not paid it yet. If you get a CP-14, you have a deadline to respond. Do not set it aside. An LT-11 is more serious. It is a final notice before the IRS takes action to collect, which can include placing a levy on your bank account. If you have received an LT-11, you need to act within 30 days. Share this video right now with one person in your family, not tomorrow, right now. Because the difference between knowing this information and not knowing it is the difference between handling it calmly and panicking when a letter arrives. Letter 6419 is specific to the child tax credit advances that went out a few years ago. If you received advance payments and they did not match what you were actually eligible for, you may receive this letter asking you to reconcile the difference. This one mostly affects people who are still claiming dependents, but it is worth knowing. Here is the most important thing about any IRS letter. You have rights. The IRS is required by law to explain why they are contacting you, what you need to do, and how you can appeal or dispute their findings if you disagree. Every letter must include a contact number. Every letter must include a deadline. And every letter must give you a way to respond. The number one mistake people make is throwing the letter away or putting it in a drawer and hoping the problem goes away. It does not go away. The IRS has a very long memory and a very large staff dedicated specifically to following up on ignored correspondence. The second most common mistake is calling a random number you find online claiming to be the IRS. Real IRS agents do not call you out of the blue and demand immediate payment. They do not ask for gift cards. They do not threaten to send police to your home. If someone calls you saying they are from the IRS and you need to pay right now over the phone, that is a scam. Hang up. The real IRS phone number for individual taxpayers is printed on every legitimate letter they send. It typically starts with 1-800. You can also reach the IRS directly at 1-800-829-1040. That is a real number you can use Monday through Friday during business hours. Check the notification bell on this channel right now. If it is not set to all, you are going to miss updates like this one. The rules change every year and sometimes mid-year, and I post updates every time something significant happens that affects your benefits, your taxes, or your accounts. Now let us talk about what you should actually do if you received one of these letters. Step 1 is to read the entire letter before you do anything else. Read it twice if you need to. Find the notice number and write it down. Find the deadline and write it down. Find the specific dollar amount or issue they are raising and write that down too. Understanding exactly what they are asking is the first step to responding correctly. Step 2 is to gather your documents. If the letter is about income that does not match, pull out your tax return from that year and compare it to the letter. If the letter is about a retirement account distribution, pull out your account statements. If it is about a joint account after a death in the family, gather the estate documents and the death certificate. The IRS is not going to take your word for it. They need paper. Step 3 is to decide how to respond. Most CP 2000 notices give you 60 days to respond. Some letters give you 30 days. Some give you 90. Your response can be one of three things. You can agree with the IRS and pay what they say you owe. You can partially agree and pay part of the amount while disputing the rest, or you can fully disagree and provide documentation to explain why their information is incorrect. If you disagree, write a simple, clear letter explaining your position. Attach copies of your supporting documents. Never send originals. Keep copies of everything you send and send it by certified mail so you have proof the IRS received it. Step 4 is to consider getting help if the amount is large or the situation is complicated. A certified public accountant or an enrolled agent can represent you before the IRS. An enrolled agent is someone who has passed a rigorous IRS exam specifically about tax law and is licensed to represent taxpayers in disputes. If you cannot afford professional help, you may qualify for free assistance through the Taxpayer Advocate Service, which is an independent organization inside the IRS that helps people who are experiencing financial hardship or who are not getting a response through normal channels. Their number is 1-877-777-4778. There is also a program called the Volunteer Income Tax Assistance Program, or VITA, which provides free tax help to people who generally earn $60,000 or less. They can often help you understand what a letter means and how to respond. Now let us talk specifically about seniors and retirees. because there are a few situations that come up more often after age 60 than at any other point in life. If you are receiving Social Security benefits and you also have other income, a portion of your Social Security may be taxable. A lot of people do not know this. If your combined income, which is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits, exceeds certain thresholds, then up to 85% of your Social Security benefit becomes subject to federal income tax. For a single person, that threshold starts at $25,000. For a married couple filing jointly, it starts at $32,000. If the IRS has records showing your total income crosses those lines, but your tax return did not include Social Security in the taxable income calculation, that is a mismatch that triggers a letter. If you are on Medicare and your income is above a certain level, you also pay a higher premium. This is called IRMAA, and the simplest way to think about it is as a surcharge on your Medicare based on how much money you made 2 years ago. The IRS shares your income information with Medicare automatically. If your income drops significantly because of a life event like retirement, divorce, or the death of a spouse, you can appeal your IRMAA surcharge. The form for that appeal is SSA 44, and you file it directly with the Social Security Administration, not the IRS. For widows and widowers specifically, the 2 years after losing a spouse are financially complicated. Your tax filing status changes, your income may change, your benefits may change, and accounts that were set up decades ago suddenly need to be reviewed and updated. If you are in this situation and you received an IRS letter, the most likely cause is either a change in filing status that was not reflected on your return, income from accounts that were transferred to your name, or a required minimum distribution that was calculated based on old account information. For divorced individuals who are receiving benefits based on an ex-spouse's work record, the IRS occasionally flags returns where the benefit amount does not match what the SSA has on file. If you are collecting a divorced spouse benefit and you received a letter, the first call to make is to the Social Security Administration at 1-800-772-1213 to confirm that your records match before responding to the IRS. For people who are still working past 65, the earnings test is something you need to know about. If you are collecting Social Security before your full retirement age and you are still working, there is a limit to how much you can earn before your benefit is temporarily reduced. In 2026, that limit is $23,400. For every $2 you earn above that limit, $1 is withheld from your Social Security check. This is not a permanent reduction. Once you reach your full retirement age, the Social Security Administration recalculates your benefit and gives you credit for the withheld amounts. But in the meantime, the math gets complicated, and it can create a situation where the income the IRS sees does not match the benefit the SSA is paying, which can trigger correspondence from one or both agencies. Subscribe and turn on notifications right now. Situations like this one are exactly why this channel exists. The rules interact with each other in ways that nobody explains to you when you retire, and by the time you find out, the mistake has already been sitting on your record for a year or two. Let us talk about what happens if you do nothing. If you ignore an IRS letter, a few things happen in sequence. The IRS sends a second letter, then a third. At some point, they issue what is called a notice of deficiency, which gives you a 90-day window to either pay or challenge the amount in tax court. If you do not respond to the notice of deficiency, the IRS can begin collection actions. That means they can take money directly from your bank account. They can garnish your Social Security benefits up to 15%. They can place a lien on your home. None of this happens overnight, and none of it is irreversible, but all of it is much harder and much more expensive to deal with than responding to the first letter would have been. The Taxpayer Advocate Service exists specifically to stop this from happening to people who fall through the cracks. If you are facing economic hardship, if you have already tried to resolve the issue through normal channels and got nowhere, or if you believe the IRS is taking action that is not correct, you can contact the Taxpayer Advocate Service and request help. They are free, they are independent, and they have the authority to intervene on your behalf inside the IRS system. Let us bring this back to where we started. The IRS sent warning letters to 5 types of accounts in 2026. High balance accounts with unexplained income gaps, accounts connected to unreported side income, joint accounts following the death of a spouse, retirement accounts with required minimum distribution issues, and health savings accounts used for non-qualifying expenses. If your account falls into any of these categories and you received a letter, it does not mean you are in serious trouble. It means the IRS has a question. Answer the question on time with documentation, and most of these situations resolve without any penalty at all. The mistakes that turn small issues into big ones are always the same. Ignoring the letter, waiting too long, throwing away documents, calling a scammer instead of the real IRS, paying something you do not owe because you did not know you could dispute it. You now know better than that. The real IRS number for individual tax questions is 1-800-829-1040. The Taxpayer Advocate Service is 1-877-777-4778. If you need help understanding a specific letter, the IRS website at irs.gov has a notice lookup tool where you can type in your notice number and get a plain English explanation of exactly what it means. If this video helped you, share it with one person you know who is in or near retirement. Not because it helps the channel, though it does, but because this is the kind of information that genuinely protects people. The seniors who get hurt by IRS issues are almost always the ones who did not know what the letter meant and did not know they had options. Now you know. Pass it on. Stay informed, stay protected, and take care of yourself and the people around you.